I would like to thank the organizers for the mic. For putting together the conference and for the opportunity to present my work. This project is joined with Renata Kosova, Praveen Kumar, and Paul Powell. And the motivation for this paper is to try to understand how well do investment perform if they were made during industry investment boom periods relative to non-boom periods. And if the performance happens to be different, we would like to understand whether strategic interaction between decision makers, namely limitation or competition, has something to do with the difference in performance. So far in the literature, there has been some evidence that investment made during boom periods tend to underperform, although this evidence comes in a somewhat aggregate form, either at the firm level or at the fund level. For instance, there's evidence that companies that go public during a hot IPO year tend to underperform for the next few years, and that VC funds that raise capital in a year where there's a large capital inflow to that industry also tend to underperform. And although this evidence is very interesting, it may have a very simple explanation. It may be the case that during some years, there's a lot of capital available, capital financing becomes cheap, the required return on investment is low, and as a consequence, the realized return on investment is low too. But maybe there's more to it. Maybe it is indeed the case that strategic interactions has something to do with the underperformance. But in order to study whether that's the case, we need more detailed data. We need data at the project level, not at the firm or fund level, and also in clearly delimited markets, because in clearly delimited markets is where projects face most of the strategic interactions. So in this project, we try to move in that direction. We're going to exploit a unique and proprietary database from the US hotel industry. This database contains information on virtually all hotels in the US, their year of construction, and also the market, defined as a county where they operate. So we can identify years in which many hotels were built in the US, and we call them aggregate investment booms periods, or even count your local market boom years, meaning a year in a market in which you observe unusual investment activity. And we can see whether that relates to the hotel's later performance. We have a decade of performance information between 2000 and 2009. And because the investment in this industry are typically sunk and long-lived, we can study both the short and long-term effect of being built in a boom, either locally or aggregate, on later performance. We can study, for instance, all hotels in the 70s and compare those that were built during aggregate investment boom years to non-boom years, or local market boom periods to non-boom periods, and see 40 years later how do they perform relative to each other. And the same holds true for hotels in the 80s, 30 years later, and so on. But of course, to make any such claim that being built during a boom or not relates to performance, we need to be able to isolate from many other confounding factors. Fortunately, our database is rich, and we can do a fairly good job in that dimension. We know the brands under which hotels operate, the quality segments they serve, the number of rooms they have, the amenities that they have, a description of the location, the touristic attractiveness of the location, the demographics, the number of competing hotels, etc. And finally, a couple of nice features that I like about the hotel industry is that relative to other industries, here markets are easy to delimit. They can be delimited geographically. In some other industries, the product space is hard to delimit. And second, the decision to invest is not very prone to agency problems, because although most hotels in the US are owned by brands like Marriott or Hilton, are operated under these brands, they are operated under franchise contracts or company managed contracts, such as the restaurant industry, with the difference that even in the company managed contracts, these are owned by real estate developers. So it's real estate developers, the ones that decide to invest, and then they later partner with these brands under franchise contracts on company managed contracts, but they still remain the property of the hotels. So let me tell you how I'm going to identify the relation between being built in a boom and performance, and later I will try to go and show you a little bit what can be under that relationship. So this is a typical revenue management industry. Here, investments are very large upfront, and operating costs are also mostly fixed. in this type of industry, once you control for everything that captures the cost function, you can compare the performance of investment in terms of the revenue per available room, which is the key performance metrics in the industry. So in particular, what we're trying to do in our empirical setting is compare, let's say, 2 Courtyard by Marriott's with the same number of rooms operating in a very similar market and all other characteristics that basically describe these hotels. So we have basically 2 otherwise identical properties with the same investment cost and compare them in terms of the revenue per available room. In the industry, they compare hotels like this, and the hotels that are below in the performance are said to be underperforming hotels. Actually, the way we got the data is because there's a consulting company called STR, which gets the universe of performance data from all branded hotels in the US. And the data is provided voluntarily by these hotels. And these hotels benefit from that because they want to purchase reports from this company in which they benchmark against each other using RevPAR, following the characteristics that I told you. Now, more into detail, what we're going to have is we're going to estimate the logarithm of revenue per available room for Hotel I belonging to brand G in County C, and the performance is going to be measured in year T as a function of a bunch of controls that control for the competitive environment, the type of brand, the type of location, etc., everything that describes the cost function of the hotel. And we're going to throw in 2 variables, one that follows the cohort effect literature, that is basically whether your hotel was built in a year in which there was unusually high activity of hotel building in the US. And the other variable is going to be entrance, which is going to measure the number of hotels that enter the same county as you did in the same year. It's going to capture local market activity. And we have tried different measures for this. So detrended, not detrended, here divided by the population of the county. Supply shocks in terms of percentage is not going to matter. I'm just going to show you this specification as it is. And the first result that we find is that when we chop the data by hotels of different performing age, hotels in their first 5 years of operation seem to underperform if they are built during an aggregate investment boom period and a local investment boom period. This first result places us to be consistent with prior papers in the cohort effect literature. But what's really interesting is that even after controlling for this aggregate effect, we find that hotels that were built with many others in the same county year underperformed their peers for many years. This underperformance is pervasive, even after controlling for the number of competing hotels in the same county on year T, which is the year in which we're measuring performance. So first, we document that this exists, and then we try to explain what is under this persistent underperformance. We believe that simple explanation cannot explain our results. For instance, credit conditions are typically homogeneous in the US, so they should be captured by the variable cohort effect, which captures investment cyclicality in the US in general. And in addition, we have control for variables that proxy for credit conditions at the county level or at the US level, and the results continue to hold. An alternative simple explanation can be that during boom periods, you have to choose between poorer sites because the good sites are already taken. Now, we don't think that this is explaining our results because we find that hotels built during a boom year perform actually worse than the ones that are built 2 years after. So if good sites are taken 2 years after, you should even have worse hotels or worse sites. And in addition, site selection is more relevant for, let's say, luxury hotels than for economy hotels, and the results ascribe equally to both. Given that the results are really important at the local market level, we believe that strategic interaction may have something to do with this. And 2 explanations come to mind. One is competition neglect, which can have many causes. But in a nutshell, what you have here is that you don't fully internalize that many others are entering into the same market as you are in the same year. And you find yourself with more competition than you expected. And to the extent that you compete really strongly with other hotels in the same vintage, that underperformance can carry on through time, even after controlling for the number of current competition, which is the number of hotels that are competing in the same market, irrespective of when in the year in which they were built. An alternative explanation is imitation or information spillovers. And what you have here, you can think of the typical rational informational cascade model. That is not going to serve the purpose because those type of models don't make any predictions about performance. You can go in a correct cascade, on an incorrect cascade. On average, you shouldn't perform worse. But if you think of a signal extraction problem where, for instance, some hotels enter into the market in a given segment and some others are observing the decision to enter of these hotels, but they cannot disentangle whether demand is generally growing in that market or is that a particular segment is suitable for that location. In that case, you may face a signal extraction problem, and then you may end up underperforming, either because you have weaker information, or you can also have behavioral reasons for that. You might have excessive extrapolation of information. We are agnostic as of whether this is rational or behavioral, but we want to see whether Herding can describe the results, and Herding in the literature, at least in his Schleifer's paper, can be either rational or behavioral. So the first test that we run to try to disentangle this is to divide entrants into entrants in the same county, same segment, and entrants in the same county, other segment. And we do the same for the variable that measures competition on year T. As you can see in the blue line, more competition in your same segment reduces the performance, so competition is relevant. But more entrants in the same years, maybe 20 years ago, has nothing to do with the performance. It is the number of entrants in the same year as you did in a different segment what drives the negative performance. And this is inconsistent with competition neglect because you compete more strongly with hotels of the same quality segment, but is at least in principle consistent with an imitation story where you basically face a signal extraction problem. Now, it is more likely that we believe an imitation story if you don't only observe that some hotels decide to enter and you just right away imitate them and you end up opening in the same year, which happens a lot, but if you observe that performance is further reduced when there are more entrants in the same county in a different segment the year before. So there's kind of a delay there. And that's what we find too. So both negatively correlate with performance. So next, we look at what happens within a county. Okay, now we're comparing the relative performance of hotels in a county. And what I'm showing in panel A is that only those hotels that were open where there was massive entry, in those years that there was massive entry in that county, are the ones that are really underperforming. That's panel A. And when we look at the boom cycle, the hotels that are open in the peak and the year after are the ones that are really underperforming. But the ones that enter before do not underperform significantly, and the ones that enter a couple of years later do not underperform significantly. And this is also consistent with the story I told you, because leaders by definition are not following someone else, and then you have late laggards have some time to observe the early performance of entrants and can refine their decisions. Finally, we try to look at whether, instead of looking at whether there was herding or inferring whether there was herding from the performance, let's try to look at the decision to build. So we estimate a multinomial logit where you can, where there can be zero entry in a county, moderate entry in a county, or massive entry in a county as a function of a bunch of economic variables that should describe the environment, the stock number of hotels in that particular county, and whether more hotels enter just before you. And we do find that you're more likely to have moderate or massive entry when there's entry the year before. However, this result is subject to potential unobserved autocorrelation. What is not subject to that is that you are more likely to rely on what others are doing when the market signals are more volatile, in this case captured by the standard deviation of the county GDP growth. So when the county GDP growth is more volatile, you tend to rely more on what others are doing, and this is consistent with imitation. So overall, what we find here is that we document that hotels or investment made during local market booms tend to underperform. This underperformance is pervasive, and then the evidence so far points out that this is consistent with herding. really nailing down whether this is herding or not is hard. I think all the herding papers face the same hurdle, but definitely, for instance, competition neglect doesn't appear to happen in the data, and this is at least all the results that we have are consistent with that explanation. Thank you.